welcome to week 21. It is Monday the 22nd of May. This is James Kim, sales trader based in Australia, recording live out of Asia Pacific. This week we will be looking at the US dollar index, some levels coming up to the downside. More interestingly though, are levels to fade these rally in the euro dollar. That level will be covered. Interesting alignment in the Aussie dollar. We'll cover some analysis there. We'll cap it off with looking at eMini futures followed by gold. So the US dollar index continues to experience a sharp fall, with the previous week's settlement coming in below the 50% retracement between the 2016 lows to the 2017 highs. The failure for the US dollar to hold these losses here is a huge negative. The rally we saw off the lows exactly 2 weeks ago proved to be useless, as momentum failed at the uptrend line which supported the US dollar all throughout 2016 and on one occasion this year. The rejection we saw at this trend line here was a technical giveaway that the uptrend that the US dollar has broadly enjoyed has now been clearly violated. On further selling this week, we have 96.44 or the 61.8% retracement as first downside level to mark. However, I'll have more of an interest at 96.11 down to 95.90 or the Trump election lows as levels to watch for a tactical bounce in the US dollar. The euro, on the other hand, unrelentingly pushes higher on the back of that US dollar weakness. Now, all long positions should be on the lookout this week, as the rally in the euro has been aggressive, is currently overbought, and comes up to some important levels this week. Now, we have the US election high coming up, which coincides with that US dollar low that I just previously covered in the chart before. However, another element for consideration is that the euro currently trades in an inverse head and shoulder formation like this. It's not the perfect inverse head and shoulder reverse pattern, but one cannot argue against this reversal pattern. The Macron gap 2 weeks ago or 3 weeks ago now coincided with not only a breakout of the 2016 to 2017 downtrend resistance line. However, this gap here also happened to be that neckline break. Now, to confirm the validity, as we break down the range between the head to the neckline range applied to the breakout level here, if we measure the distance by using the Fibonacci extension tool, measuring the distance between the head to the neckline and applying that to the breakout here, we saw the first set of resistance being experienced at the 23.6% extension, followed by 38.2, and the 100% extension comes in at just above the 113 handle. So these are the levels that we'll be exercising caution for all long positions for the week ahead. Despite the political turmoil in the past week, which lifted the market's appetite for safe havens, our Aussie dollar cleared out the week unscathed, putting some decent gains along with base metals across the board. The Aussie dollar currently trades within a channel, and Friday's high happened to find resistance at the upper channel trend line. We expect for the Aussie to continue to find resistance at this upper channel trend line. Only a break in settlement of 2 or more sessions above here changes the technical setup. Our downside levels for caution are presented at the 74 handle, followed by 73.28 or the May lows, and on further selling, weakness is indicated to terminate at the 2016 positive trend line. However, for now, we would maintain a short bias until, again, the upper channel trend line is taken out. Over to equity indices. This is a daily chart of the eMini futures. Now, from about 3 weeks ago, back on this weekly presentation, I started to highlight the diverging RSI. So as the S&P continued to hover at its 2017 highs, and with this RSI divergence, now in hindsight, this was a clear giveaway of the moves to come. Now, last week we saw the biggest one they lost for the year, and the huge sell-off we saw had set the stage for buyers to step in and take advantage of beaten down stocks. The S&P last week found support at a short-term trend line, and we're going to continue to work with this short-term trend line as support. And I must highlight that whilst we have seen a bounce in US equities of this trend line, the volume has been on the decline with this bounce. So for now, we will treat this 2-day rise, potentially another 3rd day rise today, as a mere retracement. For long only investors should continue to exercise caution as S&P starts to hit up against the 2400, where we may see just selling in front of this handle here for the week ahead. The last chart of the day goes to gold, which saw the most recent weakness being arrested at the short-term January to March trend line. The rally of this trend line saw gold last week also punch through the 200 daily moving average. Now this 200 DMA is expected to be first support this week. However, any settlement below here is expected to drive gold back to this trend line, and a failure for gold to hold above here will complete a head and shoulder reversal pattern, and we all know what this means. However, for now, this is a pure theory. It is early to draw this conclusion. However, potential development that we shouldn't discount. To the top side, we must take out the weekly or last week's high at 1264. This high here coincided with February's swing high here, so at the moment this is acting as a bit of a psychological resistance level. A break above here largely discounts that head and shoulder reversal pattern. However, again, settlement below 200 DMA, we would be cautious for any long gold positions out there. That concludes our presentation for the week ahead. Wishing everyone a profitable and a safe trading week ahead. Thank you.